Welcome to the launch of our annual Seeking Truth Through Facts U.S.-China program series. This is the first of an 8-part series. Our program is Shifting Currents, U.S.-China Economic Policy and Transition. We're here in San Francisco at Asia Society Northern California, and we're streaming virtually to our center in Seattle. It's wonderful to be with you tonight at this vital moment for U.S.-China relations. I'm Margaret Conley, the Executive Director, and on behalf of our team, we're thrilled to be hosting an expert panel featuring Dr. Yasheng Huang, Professor of Global Economics and Management at MIT Sloan, Dr. Victor Shih, Director of the 21st Century China Center at UC San Diego, and Andy Rothman, Senior China Fellow at Asia Society Northern California and Seattle, and he's going to moderate this discussion. Tonight, we embark on a timely conversation about recent economic policy shifts, from adjustments to tariffs, shifting trade strategies, and evolving regulatory frameworks. Our panelists are going to unpack not just the what, but the why, the motivations behind these policies, their economic and geopolitical impact on both nations, and what outcomes intended or not intended we might expect. Our mission at Asia Society to navigate shared futures is more important now than ever. And we are tonight in a safe space to come together to discuss the facts and the issues through various points of view. With intensive academic scholarship and deep policy insight, Dr. Huang has explored the political economy of reform in China. Dr. Shih offers keen expertise on elite politics, fiscal frameworks, and state business interactions. And Andy Rothman brings decades of expertise as both a diplomat and financial strategist, and he's going to guide our conversation. And we welcome your participation. We do want this to be interactive. We're going to start with around an hour of a moderated discussion. Then we're going to have audience Q&A. So when that time comes, our moderator will call on you. Wait for a microphone. Do introduce yourself and keep your questions short and concise so that we can get to as many of them as possible. We are recording, and this event will be posted on our website, and this is on the record. In a world of shifting currents and evolving power dynamics, let's now delve into how economic policy is shaping and not just reacting to the U.S.-China relationship. Please join me in welcoming Yasheng Huang, Dr. Victor Shih, and Andy Rothman.
Thank you, Margaret, and thank you all for coming and joining us, especially those of you who are here in the room with us. Also, everybody who's joining online, thank you for that. Thanks to the Asia Society staff and our summer interns who've done a fantastic job putting this program together. And most importantly, thank you to Yasheng and Victor for coming to join us today. It's a great privilege to have these two experts on the Chinese economy here today. So we're going to take full advantage of that. I want to set the scene just very briefly before we hear from our guests. And I want to start by talking about some of the myths that are pretty pervasive in the conversation about US-China relations and the Chinese economy today. One of the myths that we hear from Washington frequently is that getting China into the WTO, bringing them into the world global economic system was a mistake because there's been no advantage for us. We've been cheated by this. So I just want to throw a few numbers out to put that in context. Since China joined the WTO in 2001, US exports to China have increased by 646%. To the rest of the world, they've gone up by 171%. US agricultural exports to China have gone up by 1,200%. To the rest of the world, 174%. Meanwhile, US imports from China have risen by 329%. Arguably, the people who negotiated this deal, bringing China into the system, should be tremendously proud of what they've done. It's helped us become wealthier. It's helped keep inflation down here. But yet, in Washington, I think a lot of the people who worked on this are kind of embarrassed about it by now because of the political environment there. I want to talk about another myth, which is that this trading relationship we have with China gives us tremendous leverage over them, that we can now force China into a trade deal which is disadvantageous for them because they're so dependent on our markets. So I think it's important to recognize that the Chinese economy generally is not export-led. If we look at the period from when they joined the WTO in 2001 through 2019, before the pandemic, on average every year, net exports, that's the value of a country's exports minus their imports, on average every year, net exports were a negative 2% drag on GDP growth. And that's changed in the last few years because consumption's gotten weaker for a variety of reasons that Victor and Yasheng will talk about. But exports have generally been running about 2% of China's GDP. This is not an export-led economy any more than ours is. And then if you break it down to the United States, last year, Chinese exports to the United States were 15% of total Chinese exports, equal to less than 3% of Chinese GDP. This year, it's already lower, at least on direct terms. If you look at it more broadly, Chinese companies have been really great at diversifying away from the developed world towards the developing world. If you go back to when China joined the WTO, about 50% of Chinese exports went to the G7, including the United States. Now it's only about a quarter goes to the G7. The biggest and fastest growing export market for China are the 10 member nations of ASEAN in Southeast Asia, not the United States. All of this leads up to what I think we're going to spend a lot of time talking about with our guests, is the role of consumption in the Chinese economy. A lot of people don't understand that consumption is actually a very big part of the Chinese economy. As a share of GDP, it's quite small, about 55% relative to where most developed countries are, but it is typically the biggest driver of economic growth in China. Up until the pandemic hit, on average, almost 2/3 of China's economic growth came from final consumption. That share has fallen significantly in the last few years, which means exports by default play a bigger role. But that's not, I think, because the Chinese government doesn't like or value or promote consumption. It's because, in my view, there's been a complete collapse in confidence in China. Confidence by Chinese entrepreneurs, the private sector companies that employ most people, drive all the innovation and wealth creation. Confidence by Chinese consumers, most of whom are either entrepreneurs themselves or work for an entrepreneurial firm. Confidence in the Chinese government's ability to manage the economy, and that has really weakened things. And now I want to turn to our guests to talk about why that's happened and whether that's going to change in the near future. Maybe we'll start with Yasheng. Can you talk to us a little bit about your perspective on why consumption has become weak and where is this likely to go? Lately, we've been hearing the central government in China talking more and more about its desire to promote domestic demand. Is that going to work?
Yeah, so thank you, Andy. I think when we say consumption, we need to distinguish between two sets of data. One is what the Chinese government calls social consumption, and the other is household consumption. The social consumption is a broader measure of consumption, but that measure includes government consumption and to some extent the state-owned enterprise consumption. What matters is the household private consumption. The reason why private consumption matters is that the other types of consumption by the government are actually funded by the rest of the economy, the private enterprises and households through payroll tax and labor contributions. So it's not really, the Chinese government sometimes likes to cite the social consumption because it's a higher share of the GDP, but that's not really the right metric to look at when we discuss the issue of consumption. The private household consumption as a share of GDP today is around 38, 39%. Just to give you a sense of how low that is, to go that low, you have to go to countries such as Saudi Arabia. Saudi Arabia is an energy-producing economy. By definition, a country that focuses on energy production, and it has a very small population, doesn't really consume that much. So the Saudi Arabia's private consumption as a share of the GDP is around 34, 35%. And you want also to go to a country like Singapore. Singapore has a private consumption share of the GDP roughly around 30 to 33%. But Singapore is famous for its very high savings rate. Some of it is mandated by the government through a mechanism known as it's almost a compulsory savings set aside by the government, dictated by the government toward social security fund. So for a country that has 1.4 billion people, for a country that has grown, historically speaking, 8-9% a year in terms of the GDP growth, you get 39% share of the GDP in the form of private consumption. It is extraordinarily low, right? And what is also interesting is that China reached the highest level of the private consumption as a share of the GDP in the 1980s. At that time, it was about 50%. And since the late 1980s, it has declined ever since. Under Xi Jinping, it has inched back a little bit. The lowest point, I think, was reached around 2010, 2011. It was around 35%. So it has inched back to about 39%, and principally because, and this is something that many people don't recognize that has happened under Xi Jinping, principally because the rural income growth on the part of the Chinese rural residents has actually has been faster as compared with the previous leadership eras. So what I want to say is that, and then if you go back to the 1980s, the reason why the private consumption share of the GDP was very, very high was mainly because the income, the personal income, private income growth outpaced GDP growth, okay? So we need to understand this dynamic very, very importantly, we need to understand this dynamic. Fundamentally, the consumption story is an income story. If the personal income growth is fast, then pretty much, it's not one-to-one relationship, pretty much you get a high consumption growth. And under Xi Jinping, through various mostly administrative measures, income support, common prosperity measures, income transfer from the government to the rural China, income transfer from urban China to rural China, the rural income growth recovered, not substantially, but recovered by a decent margin. And that's why the private consumption share of the GDP also recovered. And now we get to the pandemic years. And there, Andy is absolutely right that during the pandemic era, the 3 years of the pandemic, 2020, 2021, 2022, it was not so much the pandemic itself, it was really the pandemic control that substantially reduced the confidence on the part of the society, on the part of the consumers in a number of things. One is employment, right? The pandemic, if you think about the pandemic control, it was incredibly effective in reducing business generations and therefore reducing employment generations. When you have lower expectations of the income, when you have lower expectations of employment in the future, then you're going to consume less, right? You're going to save more, you're going to consume less. And as long as that psychology is going to persist, it is extremely difficult to get all of this consumption slowdown. You know, if you look at the CPI, the Consumer Price Index, and then PPI, Producer Price Index, in the past 2 years, a lot of those indices are trending negative. So it is a classic situation in which the consumers don't have confidence about the future, and therefore they don't consume. And because they don't consume, enterprises also lose confidence about the future, and therefore they don't generate employment opportunities. And the feedback loop works back to the consumer sector, where because the employment generation is low, and the consumers lose further confidence. I think it's critical for the government to take, we can talk about what measures should they take, but it is critical for the government to take measures that are both meaningful enough and substantial enough and visible enough to get the consumer sector out of that psychological situation. And in my own view, and I can come back to that, some of the measures that have taken are not sufficient, are not visible enough, are not big enough to deal with this psychological issue. So I would just end by saying that it is psychology. And once a society is trapped in a particular psychology, it is really, really difficult for the society to get out of it on its own. It takes massive interventions by the government.
Victor, your thoughts on that subject?
Of course, I agree with everything Yasheng has said. I mean, I guess my one thing that I will add is that the misalignment of Chinese fiscal policies, certainly in the past 10 years, but perhaps going back even further, has really contributed to the low share of household consumption in the GDP. And then in recent years, from a fiscal policy perspective, even though real income sort of mysteriously has increased, although I'm a little bit skeptical about that data, given what Scott Rozelle and others have found, about what's happening in rural China, especially in the past 3 or 4 years. Maybe that's like a new dynamic. So with the exception of that, certainly the sort of weaker consumption, the official numbers are tricky. It doesn't really show weak growth in discretionary income. I mean, weaker than before, but it's still like 5% or something like that. But if you look at retail sales, there's no way that actually is true. Just because recently, besides consumer electronics, which have been subsidized by the government with supply-side policies, consumption of everything else has fallen, basically, or is like growing very weakly. The way that fiscal policy contributes to it is that all the fiscal firepower of the central government, which it had gained a lot since 1994 with this gradual centralization of the taxation system, has been devoted to the supply side. Not all of it, but like a lot of it. And then meanwhile, social services, even though they have grown in absolute sense, and especially for education has grown quite a bit, but for everything else, old age pension, medical care, the growth rate, as Yasheng was saying, has not kept pace with GDP. So this is a problem. It's like, yes, everything in China is getting better. Like if you look at social policies in absolute terms, they are growing year after year, although not every single year. I mean, that's an astonishing thing, is that some of these social things have decreased as a share of GDP in recent years, but it hasn't kept pace with GDP. And as a result, there's no spending power. And after COVID, so COVID was actually an enormous shock to the fiscal system in China, even though economically China sort of recovered fairly quickly. But in the fiscal system, it is still struggling from the aftermath of COVID when there was zero income for many, many months. And then basically in 2020, the central government had to get into deeper deficit just to keep the lights on, literally, in many local authorities. But many local governments are still struggling since 2018, but especially after COVID. The local debt level has really, really gone up. Even though there was this sort of debt built up, from 2008, 2009, all the way to 2020, but 2020 to 2023, 2024, we saw another massive ramp up in local government debt, such that so to give you a very concrete number, prior to 2018, most, let's say the vast majority of local governments had local debt servicing. So debt servicing is like interest payment plus repayments, monthly repayments, that is less than half of their own revenue. So this was a situation in 2018. But by 2023, basically only Shanghai, Guangdong, and Shanxi province had that situation. And most other provinces in China either would have debt repayment that's several times that of their own revenue, or it is over 50% of their revenue. So the extreme case being Tianjin, so that's my sort of favorite thing that I like to beat up on, as Andy knows. It's only one place in China, but it's quite bad. And the leader of Tianjin is now running the financial system in China. So where the debt servicing is, I think, 250% of fiscal revenue of the city. So then in that situation, a lot of, especially lower level governments, cannot pay their civil servants. Governments across China, even in the wealthy regions like Shanghai, Guangdong, they're asked to cut expenses dramatically. And by the way, in China, as you all know, the Chinese government isn't just civil servants, also includes all people who work for the schools, most of the hospitals, et cetera, and then the SOEs. So they're all cutting their expenses. So even if we were to use this larger definition of social consumption, which includes the government and all the Shih and Huang, consumption by all those different units have also reduced by quite a bit. And the thing to do now is not to go into deeper and deeper austerity, which is what the central government is constantly calling for these days. It should be the opposite, which is a stimulus. But the central government is unwilling to do it, partly because they know that there's already so much debt accumulated at the local level, which by my calculation, if you add the central debt plus all the local government debt, including the local government financing vehicle debt, we're talking about 140 to 160% of GDP. So it's a very large number. I mean, I think even the sort of IMF is saying it's 120 to 130. I'm a little bit higher. So then the fiscal room for them to have a big stimulus also is limited. So now they are kind of in a way stuck. But I think, the central government balance sheet remains pretty healthy. They can still get into one big round of deficit spending, but they're not willing to invest in a systematic retooling of social policies and fiscal policies. So I do wonder what the sort of next step will be if this situation continues.
Thanks. That's a great start for talking about consumption. And we're going to drill down more into this because I think this is way more important than what's happening in Stockholm between Scott Bessent and the Chinese delegation on the US trade talks. We're talking about the world's second largest economy, the economy that accounts for more than 20% of global economic growth. That's more global growth coming from China than from the US and the rest of the G7 combined. So whether the Chinese government can restore the confidence and get things going again there, is going to have a significant impact, arguably a bigger impact on us than whatever Scott Besson is doing in Stockholm right now. So I'm going to ask our visitors to spend some more time talking about that for that reason. Looking at some of the numbers that both of you were talking about, I agree that when the Chinese government says inflation adjusted household income in the first half of this year was up more than 5% year over year, that doesn't fit the reality that I see when I'm on the ground in China or when I'm talking to my friends in China. At the same time, though, there's another data set that indicates that income is growing and also that people are not spending as much as they should be. And that's if we look at the central bank data for household savings, it's unbelievable. Since the beginning of 2020, when the pandemic started, family bank deposits, which also include a lot of small, very small businesses that don't have a corporate account, family bank deposits have increased by almost 100% since the beginning of 2020. That's a net increase in bank deposits by families equal to more than 11 trillion US dollars. That's a big number. So to put that in context, that's more than double the size of Japan's GDP. So that to me says income is growing at some pace. People are not spending very much, they're saving it. And so for me, that means that a big fiscal stimulus is not necessarily the most important thing. The most important thing is to get confidence for consumers and entrepreneurs back so that they can start drawing down on some of that excess savings and spending it. So what I'd like to ask Victor and Yasheng is, do you agree with that? Can the government do without a stimulus if it can get confidence back? What do they need to do to get confidence back? And both of you mentioned some tentative steps. Really, I guess we would date these back to the Politburo meeting in September, where rhetoric about property, some minor policy changes, these have continued, but clearly not enough. Are we going to see more?
So I want to go back to this income a little bit. What has happened in the last 13 years is not so much that the income growth has accelerated. It is it's an elasticity measure. Basically, it is the income growth relative to the GDP growth. So that explains Victor's skepticism. It is not so much that the income growth, the numerator, has accelerated. It is the fact that the denominator has slowed down. If you look at the last 13 years of Chinese GDP growth rate, in the first 5 years of Xi Jinping, it was 7.5, something in that neighborhood. And then in the last 5 years has slowed down to something like 5%. But the personal income growth has slowed down, but not as much as the GDP growth rate. So in that sense, the income share of the GDP has increased, mainly because of the rather dramatic slowdown of the GDP growth rate. But this is an important point, which is that when we talk about issues like overcapacity, export-driven growth, implicitly we're discussing a structural issue. So it's not really about the growth rate per se, it is really about the share of the Chinese GDP, right? I think this is a point that Victor was making as well. And so sometimes you hear people say that the Chinese consumption is big, yeah, but Chinese GDP is even bigger, right? So it is really that discussion that is more meaningful when we talk about overcapacity and export-driven growth. And going back to Andy's question about what government should do, I think here I may differ a little bit with Victor. I do believe that the key is on the income side and not on the spending side. The key is on the income side. The key is on the expectations of the income. And for that income, so just to give you a sense that China today still has 700 million rural Chinese. And the estimate is that there are 300 million rural migrant workers, right? So you have 300 million rural migrant workers. You have quite substantial movement of manufacturing moving away from China. And you have tariff on goods coming out of China. Yes, China is exporting to other countries, not just to G7. A lot of it is transshipment, right? So essentially you export to a third party country, and then that good comes to one of the G7 countries. So you still can't get away from the G7 countries. And you also cannot get away from if you have an export-driven strategy, you can't quite get away from G7 countries, both because of the transshipment and also because of the high income level of the G7 countries. Let's just give you an example of Russia. You know, there are people in China who talk about, oh yeah, our export to Russia has, you know, grown tremendously. Yes, to the US, it has, the growth rate has moderated. The total size of the Russian GDP is $1.7 trillion, essentially a Guangdong province or Texas state, right? Whereas the import size of the United States is $3 trillion. Okay, so you can grow as much as you can by exporting to countries like Russia, right? You can't quite compensate for losing the market access to US and to EU. By the way, EU has a bigger trade, well, from the Chinese side, China has a bigger trade surplus with EU than with the United States, right? So if you have an export-driven strategy, right, then you are going to be concerned about what's happening in the manufacturing sector, what's happening in the service sector, what's happening to the 300 million rural migrant workers, right? If their income growth is going to slow down, no matter what you do with other things, you can't quite get a consumption-driven growth. Okay? So my third comment is, to me, the most reliable indicator that the Chinese government takes consumption-driven growth seriously is their willingness to accept a lower GDP growth rate. That, to me, is the most reliable indicator. Whereas the whole discussion is about how to use consumption to maintain fast GDP growth rate. Even in the best situation, consumption-driven growth is never going to match investment-driven growth. Investment-driven growth has higher multiplier as compared with the consumption-driven growth, right? And the investment, basically today's high investment growth rate is tomorrow's export-driven growth when you don't have high domestic consumption. So even if we assume away geopolitical tensions and tariff and all of that, to shift from a investment-driven growth to a consumption-driven growth is always going to accompany a lower GDP growth. That has happened to Japan, that has happened to South Korea, that has happened to Taiwan. It doesn't mean it's bad. I think in the long run, a more sustainable rate of the growth, which is driven by consumption, which is driven by, I would argue that the best thing that Chinese government can do, one is to announce a lower GDP growth rate, and the other is to support the households through social security, through healthcare reforms, educational reforms, and through mostly structural reforms, such as abolishing the hukou system. The abolition of the hukou system is going to equalize the social protection of the urban Chinese and the social protection of the rural Chinese. by that measure alone, by the calculations of some Chinese economists, Chinese consumption, private consumption can rise by 3 to 4 percentage points, right? So, and yet I haven't seen anything, even remotely close to those measures. So that's why I'm not optimistic that they can successfully transition to a consumption-driven growth.
Well, I guess, again, I'll agree with everything Yasheng is saying. I guess the one thing I would add is, to me, the only way to finance a more robust social welfare system is if you were to get rid of the export tax rebate, which will provide 2 trillion RMB per year. Well, of course, then the amount of export will fall. It's not going to be exactly 2 trillion. And also you get rid of other additional tax breaks. So of course, this runs contrary to decades of Chinese industrial policy. So politically, it's very unlikely.
That's true.
But it has a lot of different benefits. First of all, when you get rid of these tax breaks, there will be massive consolidation in the industrial sector, which of course will lead to a lot of bankruptcies. The good thing about the Chinese financial system is that it can sustain a lot of bankruptcy because all the banks are state-owned. It has dealt with huge wave after wave of large NPLs with relative success, I would say. You just push it aside, bury it into some AMC and move on from there. They can do it again, so it's not a problem. It may temporarily generate some unemployment, but you now can finance even more robust unemployment insurance with higher tax receipts. And then the survivors will have pricing power and greater margins and might actually kickstart the equity market in China. Finally, with, I don't know, you're the expert. You can tell us why market cap in China remain, is sort of stagnant. My hypothesis is that you don't have earnings, you're not going to have high market cap. I mean, people have to see that there is enough pricing power for margins to grow year after year. You just haven't really seen that for most Chinese. I mean, there's a couple of Chinese companies, which of course have done very well on that front. So there's that benefit. And if you were to split the tax receipts from VAT, with local governments will have their own sources of revenue, which again, they can spend. Local governments, I think, is a huge engine for final consumption in China. So recently, as many of you know, Xi Jinping ordered no more alcohol in any government meetings. It was a disaster, that millions of restaurants went bankrupt, etc. Then they were like, oh, well, this is a bad idea. Let's reverse that. I mean, by the way, as a party historian, I would add that during the Long March, which was a pivotal event for the Chinese Communist Party, the leaders of the Chinese Communist Party, I don't know about survived, but did a lot better, their feet especially, because of Maotai, because they drank the Maotai and soaked their feet with Maotai. So it is in the tradition of the Chinese Communist Party to consume alcohol. So banning it is to me very, very, bad. So they reversed the ban, so it's going to be a little bit better. But most local governments are bankrupt. So even if you reverse the ban, they don't have any money to spend on, certainly not Maotai, maybe, Xiao'er, like the Arguotou, small bottles. So if you give local governments more fiscal spending power, more their own sources of revenue, and relax some of these very austere rules on government expenditure, it will do a lot to lift government spending and then ultimately social spending. And then the central government additional tax proceeds can be used to build a more robust debao system. Because right now, debao, which is the minimum social safety guarantee, the amount is tiny. They announce some kind of increase year after year, but this year was 200 yuan per person per year, which if you break it down by month, it's $2 a month. I mean, that's not going to have any impact on consumption. The amount needs to be triple, roughly speaking. And with newer tax proceeds and some degree of central level deficit spending, it can be tripled. And then, that in itself, if you give the poorest people a lot more money, they will start spending money. Yeah. We know this from the case of US during the COVID. And then you also use it to finance a more robust health insurance scheme. Instead of asking, oh, by the way, it's going to be really hard for China to have a very robust pharmaceutical sector if you order them to compress prices, by 90% in some cases. So that a lot of these medicine, that each dose costs 1 cent Chinese yuan, there's not going to be any margin in that. So that's an idea, but I think central leaders are very resistant to it.
Well, I'm not much of a Moutai drinker, but I would note that these regulations have also killed the wine industry in China, at least temporarily right now. But let me push back on what I think is the notion from both of you that the Communist Party leadership is stuck in a rut and isn't going to be able to get out of it. And to do that, let me reveal my kind of fundamental bias, which is that over 40 years of looking at China, I've been really impressed with kind of two fundamental things. One is the incredible resilience of the Chinese people. They have bounced back from everything that nature, the Kuomintang, the CCP, and the US government has thrown at them. And also, the last few decades, the pragmatism of the party when it comes to economic policy. They make a lot of mistakes. We're seeing that today, but they typically tend to course correct and move on. That's why when I first started working in China, per capita income was poorer than Haiti and Afghanistan. There were no private companies at all. The party told people where to live, where to go to school, what to study. You needed a chit from the party, approval from the party to get a plane ticket or a train ticket to get married to somebody. All that personal freedom, not political freedom, but personal freedom has improved, and the economy has obviously grown at an amazing rate. So are you guys arguing that the party is no longer able, it's ossified to the extent where it can't be pragmatic and transformative? It can't go from a place that had no private companies and no savings and no privately owned housing, that those days of being flexible and pragmatic are over, and therefore we're seeing the inevitable long-term decline of China?
I think there is a fundamental difference between the early generation of reforms, which have to do with giving enterprises and private entrepreneurs more freedom to operate. And even some of that has been taken back, right? So, but I do want to point out that there's a difference between doing those things and creating institutions that are necessary in a market economy where most of the employment is generated in the private sector rather than in the state sector. So that creation piece, right? New institutions such as employment protection, social protection, pension reforms. I think the past, there was I was actually involved in one of the projects in the late 1980s to sort of create some sort of employment protection system, and it didn't go anywhere, right? So in terms of those reforms, relative to the reforms that have given Chinese people more economic freedom, relative to those reforms, these institution building reforms in the last 40 years have been far fewer and more distant in between, right? The Debao system that Victor mentioned. And in fact, they have done worse. In the late 1980s, during a period of economic slowdown, they actually reduced the level of minimum poverty standard. They reduced it 3 times in 1998, 1999, and 2001. It was really remarkable. And then if you adjust for the inflation, a lot of these Debao level didn't keep up with the inflation. So I would argue that the reforms that would enable the government and Chinese economy to invest in its own people, those reforms have not happened remotely on the same scale as those reforms that build power plants and build infrastructure and build EVs and the batteries, right? So, but I believe that the Chinese economy is at a stage, and Chinese economy is at a per capita level, per capita GDP level, where it is more important to build those institutions. And the evidence so far is they have not.
Yeah, no, so I would say also another reason doesn't have anything to do with like how the leadership thinks or anything like that. I think one reason why we don't expect a lot of changes in policy is because the policies have been successful by the standard they set out for themselves. Which is, so again, when Xi Jinping said, oh, we have to overcome all these bottlenecks, he's not thinking about, profit margins for companies. He's not thinking about the impact on, social welfare or the tax system, etc. What he wanted was for Chinese companies to produce all these different components so that China is not dependent on other countries. By that standard, these policies have succeeded.
Yeah, made in China 2025.
Yeah, made in China. Widely successful.
Yeah.
So why should they change it?
Yeah,
right. So every time you're like, oh my God, there's all these subsidies, is causing all this distortion. There'll be someone who raised their hand in the state council and say, wait a minute, why are you saying that this is a problem? Like we have overcome this dependency on foreign imported parts. This has been successful. If the Americans put pressure on us, we have to double down and subsidize these industries even more. Yeah. And that's exactly what we're seeing right now.
But forget about the Americans. Don't you think Xi Jinping's sitting in Zhongnanhai thinking, there's a lot of data telling me that things are getting pretty bad here. One of you mentioned Scott Rozelle before. If you look at the survey work that Scott at Stanford has done recently, the level of optimism among Chinese people has come down about the future. One of the things that struck me about that survey was when they used to ask that survey and ask people, why do you think some people get ahead in China? It was because they work hard and they're smart. Lately, they've been saying it's because they have good connections. Youth unemployment, according to the government's like 14, 15%. It's probably higher than that. You don't think that Xi Jinping is thinking we have to make more major changes now because what we've been doing was really successful, but that's played out?
Well, no, but who's going to tell him that? Look at the Politburo composition. There's a bunch of industrial SOE guys who are all like, oh my God, everything's great. We've just overcome this bottleneck today, but we need more subsidies, oh, Ministry of Finance, whatever, PBOC, give more relending for this and
so
that.
when there was a Politburo meeting last September and they made some changes, not enough, I kept asking people in Beijing, why all of a sudden did Xi Jinping make these changes? And what I was told is while he was traveling around the western part of the country, he met some local officials who grabbed him and said, things are actually much worse than your buddies are telling you in Beijing. And that led to some change.
Yeah, they did a transfer payment to local governments because, people couldn't turn the lights on at the county level. So there's, oh, okay, we'll write a check, whatever. Somebody will pay for it, PBOC, print some money, pay for it. That's not a change in policy. That's like, there's a fire, just put it out. So he's not making the connections that a lot of these industrial subsidies is indirectly also leading to low consumption and poor economic performance.
I don't think. The biggest issue is that he and many other Chinese leaders do not think about the world in terms of trade-offs, right?
Yeah.
So they are not willing to say, okay, this unemployment and consumer confidence problems and the income problems, there is a trade-off between improving those things vis-a-vis pouring more money in infrastructure, pouring more money into production, pouring more money in Made in China 2025. in part because they just don't see the world in those terms because of the metric that they focus on. They can maybe briefly mention those, problems and unemployment and things like that, but the whole system is based on metrics that don't pay attention to those things, right? So that and there is a almost ideology that we can grow the economy and grow out of the problem by growing the economy, right? So I have done this using the AI to analyze the policy statements by the Chinese government. And there is a document that every year Chinese government issues about planning and implementation of economic and social policies. There's absolutely no evidence in that analysis that they pay more attention now to unemployment, to income, to whole core reforms, to pension. The gap in the last 13 years between supply side policy emphasis in those documents and the demand side policy emphasis in those documents, the gap has grown dramatically, right? Even after 2022, when the Chinese government itself acknowledged high youth unemployment, right? But then if you look at the terms that emphasize the importance of the employment, it has declined, right? So I think there is a systemic feature to this phenomenon, and in the past, I think so. This is where the export sector has played a very important role, which is that at least in the past, the Chinese export production was relatively labor intensive. So when you had labor intensive production, it typically would be generating income to the rural Chinese, rural migrant workers. So essentially it served as a de facto social protection mechanism, right? If you have long-term employment in the export factories, basically you have a lifelong income without government really doing much of it, right? But then China has moved to more capital-intensive exports, and then the labor-intensive production has moved to Vietnam and to these other countries. So essentially, you don't even have that as a source of a longer-term income to the rural labor migrant workers, and I think so. If you look at the policy statements addressing that issue, it has virtually disappeared, right? Which is really remarkable. 700 million rural Chinese, 300 rural migrant workers, contrast with the emphasis they put on the rural migrant workers back in the 1990s and early 2000s. It has actually virtually disappeared in the last 2 years.
There's no more poverty in China.
Yeah, that's right. It was declared as non-existent, right? Yeah.
Well, I've got 47 more questions I want to ask Victor and Yasheng, but I'm not going to do that because we're going to turn to audience questions in a moment. But I am going to ask you guys one more question and ask you both to just give a very, very brief answer before we go to the audience questions. So if you think that we're not going to see these dramatic policy changes to promote domestic demand, what's the main obstacle there? Is it just that Xi Jinping doesn't know what's going on? Is it he's become ideological? All of a sudden he's become a strict Marxist or Maoist? Or is he just stubborn, or is it something else? What is the obstacle here that he's not overcoming?
Well, one, the sort of interest group dynamic I described, but I think the geopolitical tension has something to do with it.
Yeah.
Because China, just like some people in the US, China feels that, well, we're in this life or death struggle with the US. We need to not have these bottlenecks in this and this and this technology. So we have to throw everything we have at these things. Other things, as long as it's good enough to maintain stability, then it's, that's the bottom line, then it's okay. I think that is one obstacle.
Okay,
Yeah,
Yasheng?
so I agree with that. The geopolitics has entrenched this view that we need to invest in technology rather than in other things. But I would argue that the best way to decouple from the US and from the rest of the world, not decouple, but reduce your dependency. So essentially, the trade war has brought about two sorts of issues. One is technology, and the other is economic dependency. The Chinese government has paid a lot of attention to the technology side of the issue. Inadvertently, by doing that, they have actually increased their vulnerability and exposure on the economic side, right? Because the technological investments have generated not a lot of employment, have not really helped a lot of the sort of the average Chinese citizens. So they don't really generate broad-based income growth. So it doesn't really help the consumption-driven growth. And you are increasing capacity without increasing the consumption potentials. So therefore, you are increasing dependency and exposure to the world economy. So arguably, by focusing so much on the technology, you are exacerbating this dependency on the export-driven growth. And now we are in the era of geopolitics, protectionism, retrenchment from globalization. That strategy, which got them out before, I think is increasingly problematic.
Okay, we'll go to your questions now. Please raise your hand, and one of my colleagues will get a microphone to you. And as Margaret said earlier, please try and keep your questions brief so that we can give more people in the audience time to ask questions. Thank you. Pierre, please.
Or louder.
Yeah, but they need to record, I think.
Hi, Nick Sarkeesian, longtime Asia Society member. So by all appearances, from my naive point of view, the last generation has seen China grow so incredibly in terms of its manufacturing capability, such that, kind of bringing things back to the US relations, such that the US is reticent to put all of its eggs in one basket. There's this huge supply chain that's been built up. So my question basically is on sort of like two different aspects. Is the US's current policy to shift manufacturing away even logically makes sense, and two, even possible, number one? Number two, with respect to the export controls that have then been placed on China by the US, also, is that beneficial in some way, or how do you see that just from an economic perspective?
Just very quickly. So it has been heavily discounted. Basically what we've done is, in addition to export control, we've imposed higher tariff rates on Chinese-made goods than for other countries. First, we are shooting ourselves in the foot in several different ways. One is imposing tariffs on even allied countries or countries that are in the US, Canada, Mexico economic region. That never should have been the case. And then on top of that, the impact of these policies have been discounted by Chinese counter policies to increase subsidies on Chinese firms. So this is why I think, to the extent that there's some kind of negotiations, like serious negotiations, that's not like, oh, you have to buy another 500 billion in Texas oil, or something like that. Serious negotiations must include discussion of how the Chinese fiscal systems has subsidized industries in China. So that subsidies must be reduced over time, or you will continue to have pretty broadly uneven playing field between Chinese firms and American firms. Of course, a lot of it is kind of futile also, just because a lot of production China, just objectively, even without the subsidies, they do it a lot better than we can. So we should be able to just buy from China, with the exception of certain strategic technologies and industries, et cetera. But I think it will be quite some time before we move back toward the free trade world, unfortunately.
So the export control is not about getting manufacturing back to the US. That's a separate set of policies and policy intentions. In terms of getting the manufacturing back to the US, I see a lot of mixed developments and signals. So one way, so Trump administration, I think, is hostile toward trade, but relatively friendly toward investment. That actually, arguably, is the right way to get manufacturing back to the United States. What you want to do is you want to raise tariff, and then you lower the barriers against investments. In terms of manufacturing, and so the foreign firms can come to US and make investments. In manufacturing, there's no way that the US can really launch manufacturing boom without some sort of involvement from Chinese companies. Chinese companies have the know-how, they have the expertise, they have the capabilities. By the way, China grew its manufacturing capacity and capability by getting a lot of expertise from Taiwanese companies, Japanese companies, and Korean companies. Manufacturing is a very process-intensive activity, people-intensive, technician-intensive, engineering-intensive, learning by doing, right? That involves a lot of people who are very good at manufacturing. You can't really launch manufacturing from a textbook. So that's, I would argue that combination of what has come out from the Trump administration arguably is favorable toward this manufacturing objective. What is not favorable is that, as Victor said, they have tariffs on lots of other countries as well. China has the most competitive manufacturing sector. If you have tariffs on Chinese goods, but you also have tariffs on other countries, that doesn't change that relative cost competitiveness of the Chinese companies. They still maintain the same competitiveness precisely because the US now is also going after other countries in terms of their tariff policies. If I were the US government, if I want to get manufacturing back, we can debate that whole premise, but let's just say that I accept the premise that we should get manufacturing back to the US. I would impose tariffs on Chinese goods, but go out of the way to try to get Chinese companies to invest in the United States. I will actually lower tariffs on other countries, right? So that is that package of the policy that we don't see coming from the current administration.
When I was in China in April, I hosted a group of entrepreneurs for a dinner in Xiamen, and they had all seen the video of Commerce Secretary Howard Lutnick saying that he wants an army of millions of Americans screwing tiny little screws into iPhones. Every one of them had seen that video, and their question was, really? You guys want, we don't want those jobs. You can have those jobs. But I do think that the fact that President Trump keeps postponing the higher tariffs on China may be a reflection of the fact that he's starting to understand that American companies and consumers will be paying those tariffs, and that one of the reasons that he won the election was on a promise to bring down inflation. So maybe there's a 30% chance right now that there's going to be a deal with China, which is going to include relaxing most of the export controls on Chinese technology sectors, and also charging a tariff on China that's no higher than the baseline for the rest of the world, which seems to be 15% now.
Yeah. I think there's a question
over here, please.
Hey, Ben Livesey, Matthews Asia. China's challenges mean different things to different stakeholders. What would you say to investors how they should look at China? I mean, that's a pretty broad question. But it would seem that the old high-growth China isn't coming back anytime soon. And the government's focus on pursuit of technology wouldn't seem to be a platform for broader growth and an increase in private consumption. Are there any green shoots of optimism you see?
Well, so I think the biggest challenge to the investors is to ask the question, where's the margin, right? And the technology story is compelling. China now has DeepSeek and EV and all of that. But I mean, if you look at DeepSeek, 99.999% subscribers are Chinese, right? So this is a very limited usage outside of China. And the EV and the battery is probably a little bit better, but EV sector is hyper competitive, right? And BYD, you know, the best company, I don't think BYD is making a lot of money. And also when you have a technology story, technology, remember, has a two sides. One is that it is creative, like AI is very, very creative now, but it is also destructive simultaneously. And if you look at the auto sector in China, the EVs are growing, you know, the EV companies are expanding, but the internal combustion engine companies are suffering. So as a sector, at least in a transitional period, you actually don't experience margin growth. You actually have either stagnation of the profits or deterioration. So that, I think for the investors, this is a question that they have to ask, you know, where's the margin? And the other question is, how do you interpret the China story today? Quite set aside the geopolitics and geoeconomics. How do you interpret the following following scenario where China seems to move ahead in terms of technology, but in terms of the economy, it is quite weak and a lot of concerning developments on the economic side. Typically, we believe that technological successes are going to bring about fast productivity, performance, and growth. So far, evidence suggests it has none of that, right? So, you know, the famous Made in China 2025, there was a study of Made in China 2025. It has generated zero productivity, even though they have hit all the targets, you know, like ahead of the schedule. It has generated zero productivity benefit. It has generated zero benefit in terms of patents and all of that. So I think that's the story that investors have to wrestle with. And it's a very complicated story because you kind of have to go beyond these numbers to really understand the underlying dynamics. And this is what you don't see in the media, right? And in the social media, they say, oh, China 2020, smashing success, right? EV, smashing success. Battery, smashing success. Yes, they are smashing successes, but their broader impact on the economy is much, much more complicated.
Yeah, so I have a slightly different take, I guess. You know, China is the second largest economy. I'm turning into Andy soon. China is the second largest economy in the world. It's ludicrous not to allocate something in China. I mean, you could say, yeah, you know, and I'm the first one to say there are all these structural problems and so on and so forth, but it is the second largest economy in the world. It's, you know, routinely leads EM countries in terms of growth rates. is the official growth rate. Of course, you have to discount a little bit. Even after you discount the growth rate somewhat, it's still growing pretty well comparatively speaking, especially compared to countries with similar income levels, which is already sort of middle income. So then you have to pick the companies, with the pricing power. And then I would not touch Chinese banks because all the bad things in China are buried in the banking system. And if you do things selectively, which I'm sure you guys do very well, I think it has a role in everybody's portfolio. The exact proportion is up to people's risk tolerance and all that, but it is the second largest economy in the world.
But that's a fair point. But even when China was growing very fast, Chinese stock market has systematically underperformed compared with its economic performance. Now the question is that the economic performance is less stellar as compared before. Then we have to have a magical story to say that the Chinese stock market, for some reason, is going to overperform that, right? So I don't have an answer. I have a question, right? So that's...
No, I think the answer is very simple. Like companies that can expand the market very aggressively, successfully in Southeast Asia, which include Indonesia, it's a giant country, they will do well. Across software and hardware platforms, whoever can do that is going to do well.
Yeah, I'm not. So okay, I think the issue is really the aggregate performance, right? So the fact that they are leaving China, leaving behind the supply chain and all of that, you are taking a huge chunk of the business out of China. The businesses that remain in China, which rely on the orders and the contracts, they are going to perform less well, right? So I think when the GDP growth is 8 or 9%, we don't have to pay attention to these things. When it is growing at, say, 3 or 4%, even at 5%, these allocative issues are becoming really, really important.
I would just add that since the start of this year, the MSCI China Index has substantially outperformed the S&P 500, but
thanks to President Trump, I think.
Very few, because of President Trump and the
That's
rather adversarial political environment here, I think very few American investors are paying attention to that. Also worth noting that this morning the IMF published its updated global economic forecasts, and they're forecasting GDP growth for China to be this year and next year double the pace of the United States and the fastest growing major economy in the world, except for India.
Yeah, it's very important to point out, and I know this for a fact, IMF does not do its independent analysis of Chinese GDP growth. They take Chinese government data at face value. And I think the focus of that is more about downgrading the US growth rate, given all the tariff and chaos that we are experiencing in this country.
I'm afraid we're running out of time. Is that right? Do we need to wrap up now? But before we do that, sorry, Margaret, I just want to give each of you 1 minute to talk about what you're doing next, what people in the audience who can look for from you if you have a book or a project coming out. 1 minute for each of you, if you don't mind.
I'm at the 21st Century China Center. We have a China data center. We're gathering a lot of data on different things, including elite data. So we will release some of our findings to the public in the coming few months, I think.
When you say elite, you mean elite politics, leadership?
It's more policy, actually. So there's a data set of all the central party meetings, the ones that are publicly disclosed by the official press, of course. And then we do this also, actually hand-coded topics, because I think it's important. The first cut has to be hand-coded across 100 different policy areas to see which policies they're actually spending time on. So I think will be interesting to me, at least. I don't know if no one else finds it interesting, that's okay.
No, Victor Center has done remarkable work on data construction, database, and really just incredible. I have a new book coming out in January 2026 that is more descriptive history of reforms and reversals between 1978 and, so I finished the book 2024, 1978 to 2024. And the book maps a key milestones in the Chinese reform history, right? 1978, and then 1989, and then 2001, the WTO, and then 2008, the financial crisis, and then the pandemic era. So these are the major milestones in the Chinese reform history. They change policies in one way or the other, but some changes are more substantial than others. So my book goes into those issues.
Wow.
Okay, I'm afraid we're going to have to wrap it up there, but I want to thank Victor and Yasheng for coming and joining us today. Also want to encourage everybody who's watching, if you're not already a member of the Asia Society of Northern California in Seattle, please check out our website and join us to help us sustain programs like this in the future. Margaret?
Let's hear it for all of our speakers. We'll be following all of your work, so please come back, all three of you, and speak with us often. This conversation makes it clear that the US-China relationship is complex and it's also evolving, and we need to understand the strategic intent behind the economic decisions, and that's going to remain critical to what we do at our centers here. So we hope this dialogue offered fresh nuance, and we encourage you all to join our upcoming programs. I'd like to take a moment to thank our team, Amanda, Christy in the back, Jason, Margaret, Evan, Paul, and all of our interns. Let's please thank our team. And a few upcoming events to mark on your calendars. Our next executive roundtable, Ports of the Pacific, that's going to be in Seattle on August 11th. Northern California members are invited to join by Zoom. 4 Consuls General on soft power, that's going to be August 21st right here in San Francisco. We're launching a new tech series, a lot of conversations about technology here tonight. That is going to launch on August 28th. We're going to be talking about AI, quantum, the reverse talent brain drain, so stay tuned for that. And our Seattle annual event is on September 9th. Our global CEO, Dr. Kong, is going to join us. So if you want to make a trip to Seattle, you are welcome to be with us. So thank you again for being with us. Thank you to our excellent speakers tonight. And we look forward to seeing you at future events.